This is an empirical analysis of the performance of equity strategies that use ESG ratings. So we titled the paper, Honey, I Shrunk the ESG Alpha. So we borrowed from the title of this 1980s movie, Honey, I Shrunk the Kids. So in the movie, you have normal-sized children that end up being about 1 centimeter in size. We have a very similar shrinkage effect here. And what looks like quite sizable outperformance actually turns out to be extremely small when you conduct further analysis. So let me explain what we are doing in the paper. So what's our starting point? Our starting point is some reference papers. So we look at different publications. Some of them published in practitioner journals, some of them just white papers. And all of these different papers conclude that there are actually performance benefits to using ESG scores when you build equity portfolios. And these papers all use ESG scores in a somewhat different way, but they all end up with a similar conclusion. So they talk about, for example, a performance advantage of higher ESG rated companies. And so what we try to do is just go back to these papers and go back to these claims and just see whether we can confirm these findings. So we construct ESG strategies that target the same kind of use of ESG scores, and then we're going to assess the performance of these strategies, accounting for several different risk adjustments. And that's really the key contribution of our paper, is to actually conduct these different risk adjustments. And so if findings are robust, you would think that the performance benefits should still be there when you account for these risk adjustments. The adjustments we use are quite standard. So you have the list here. We adjust for things like sector biases and factor exposures. So that's really just performance analysis 101. Very simple adjustments that anyone who analyzes performance of a strategy should definitely do. A second point is we also look at downside risk, and that's just to make sure that we don't omit certain types of risk benefits of ESG strategies. And finally, we also look at shifts in investor attention to ESG. So you hear claims now that some of the performance of ESG strategies may actually be driven purely by the fact that investors increasingly load on these strategies. 20 years ago, most investors wouldn't have discussed ESG issues. Today, if you just look at any institutional investor, any product provider, ESG is everywhere. There's lots of attention, and so there's a hypothesis that this could actually have driven some of the performance. So we also adjust for that, but again, in a very, I think, simple way. So we conduct all of these adjustments, and then the question is, what do we find? So here's kind of the key findings that we have. We find that the ESG strategies that we look at actually do not generate any discernible alpha over and above information that is already contained in sector classifications or in factor attributes like value scores, quality scores, etc. So there is no significant alpha once you adjust for these risks. And again, these are pretty basic adjustments. We also find that this conclusion doesn't change when you account for downside risk protection. There's actually not much evidence of any significant downside risk protection. And finally, when looking at investor attention to ESG, so we use different proxies for investor attention, we find that performance is actually mainly occurring in the periods when investor attention is strongest. And if you just look at sub-periods when investor attention is a little bit weaker, performance is likewise a lot weaker. And so we think that adjusting for attention also has interesting insights on performance benefits. Now, those are the findings that we document, I think, quite extensively in the paper. So what does that lead to as a conclusion for ESG investing? And we just want to make it clear that the fact that we don't actually confirm these claims of alpha, that doesn't actually say anything about ESG strategies being not interesting for investors. Investors do not necessarily have to look for alpha in any investment strategy they pursue. There may be lots of different benefits to ESG strategies. What we're just finding here is clearly not a criticism of ESG investing. Investors may have perfectly valid reasons to invest in ESG strategies. They may actually derive benefits from investing in ESG strategies. What we find, though, is that the claims that have been made that these type of ESG strategies generate alpha for investors, well, these claims simply don't hold. And so that's really the main conclusion of the paper. Now, let me just explain briefly how we construct these strategies, and then I'll go to the performance assessment. So we're using ESG ratings data, and we have about, in the end, enough data for a little more than a decade on that. So these are, kind of typical ESG scores. So they range on a numerical score from 0 to 10. But of course, lots of qualitative analysis goes into finally, generating this number. So we're just looking up data on the ESG scores, and obviously this is one particular rating. We do not, extensively test other kinds of rating methodologies. We just want to point out, however, that these ratings, they're not probably the most exotic ones. They're actually widely used in the industry, and they're also actually underlying some of the papers that we take as a starting point. So that's a good reason to use these ratings, but we do not, obviously conduct an extensive analysis of all kinds of different ratings providers, and there's so many of these. We look at the individual dimensions of ESG scores, so the environmental, the social, and the governance dimensions. So these scores, just to explain briefly how they are created, these scores are based on assessing a number of key issues. And lots of analysis goes into that. So the key issues are actually not necessarily the same, and they're weighted quite differently according to the industry that a firm is in. So just as an example here, in the automobile manufacturing sector, like product safety is the key issue for the social pillar. In other industries, the key social issue may be different. So for example, in the household appliances, it's the highest weight is on the supply chain labor standards. Okay, and so the idea behind this is that not ESG is not the same in each industry. So again, there's quite detailed analysis, not only coming up with the evaluation of these key issues, but also how you actually weight these key issues. So that allows us to look up basically an E score, an S score, and a G score for each stock. We're also looking at an overall aggregate ESG score, which we just use as the weighted average of these individual scores. Again, this average, we could just equal weight the E and the S and the G, but it's not as simple as that. So the provider actually indicates weights for each industry for each of these dimensions. So for example, in banks, the environmental score is only 9%, and for chemicals, commodity chemicals, the environmental score counts almost 70%. So the idea behind these weightings is to capture what the provider calls the forward-looking materiality of these different issues. So there's some debate always, when you look at ESG ratings, whether or not you're looking at the material issues. So again, what is important here is that we're actually accounting for this idea of materiality. We're accounting for it in the way that this provider does. Okay, we're just accepting these weightings from the provider who claims to address forward-looking materiality in these ratings. So we don't take a view on what's the right and wrong way to deal with materiality, but it's clearly something that is already included in the scores that we're using. How do we construct the portfolios? Well, we just look at standard equity index universes, large and mid-cap for the US on the one hand, and the developed markets, excluding US on the other hand. We create long-short strategies. So we go long the ESG leaders and short the ESG laggards. And then we're just going to look at returns for these strategies. And we roughly have a 13-year period And that's just conditioned by the availability. So the ESG ratings data starts in 2007. We need that to construct strategies so we can actually start investing, if you will, on January 1st, 2008. So that's what we're going to look at. What kind of strategies do we construct? So again, we go back to these different papers that I mentioned, and there's essentially three types of use of these ESG scores. The first one is quite simple. So you just look at the overall ESG score of each stock. So that's the first version. And also you can look at the overall E, the overall S, and the overall G score. So that gives us 4 strategies that basically just use the level of the ratings. Okay, so you're going to go long the ESG leaders and short the ESG laggards, or going to go long the E leaders and short the environmental laggards. Okay, so that's a pretty simple strategy. We also look at a strategy that looks at ESG momentum. So that's another one that has been proposed in these papers. So instead of favoring the ESG leaders that have a high level of rating, this one actually looks at stocks that have an improvement. So you're going to basically not favor the ESG leaders, but you're going to favor the ESG improvers. So those companies that have an improvement in the ESG score. And finally, we're going to combine ratings level and ratings momentum. So this is also an idea that has been proposed in these papers. And so we just select stocks in the long leg that basically have a high ESG score and also don't have low ESG momentum. And this combination, just integrates both the idea that you want to hold, the companies with good ESG practices, but also among those, you want to make sure that you don't pay too much attention to those that have actually deteriorated in the ESG score. So those are the 3 types of strategies we look at. So given that there's the aggregate ESG and the 3 different subcategories, we have 6 strategies in total. They're all using the same ESG ratings, but they're using them in a different way. So let's look at the performance analysis. So first I will look at factor exposures and sector biases. Again, that's probably the most basic kind of adjustment that anyone would like to make. Then we're going to look at downside risk and finally at attention shifts. And I'll just present the results on these different types of adjustments. So first of all, this is what you get if you're just looking at simple returns of these strategies. And here we can see that our results are quite similar to the ones that have been documented in the papers that we take as a starting point. So you can see that, if you look at this, kind of naively, well, this looks pretty good. So you're getting positive returns to these long-short strategies. So that implies the ESG leaders actually have higher returns than the ESG laggards over this roughly 13-year period. So for the aggregate ESG score, you're getting performance of something like 1.3%. For the environmental dimension, you get almost 3% per year. So these are clearly, economically important performance benefits. And that probably explains that, actually providers can make these claims, right? And can claim that there is interesting performance to these strategies. Here's a time series perspective. So this is just plotting the same returns cumulatively over time. And this is probably the most typical graph that you see from providers. So this kind of graph, I've personally seen that everywhere in different presentations, blogs, papers, etc. So you have these kind of upward sloping lines, showing you that ESG strategies actually did have higher return over that period. And you can see it's quite substantial. So the scale of the graph, it goes up to 50% cumulative over these 13 years. And, you can see some of these strategies, they actually almost reach the upper bound of that graph. So, clearly there's substantial returns, again, if you just look at the simple returns. You can already see something interesting here. If you just, loosely look at this time series plot, you can see that things, seem to look much better starting in around 2013. And this is quite interesting because, effectively we do find that some of these papers actually omit the earlier half of the sample. And so if you just, kind of draw a line in the middle of the graph, you look at the left-hand side and the right-hand side in the US, for example, you can see that omitting the first half probably will lead to more favorable results. And I'll discuss that a bit more when we talk about attention shifts. Now, these results, they're not super interesting for investors because, investors do not only care about returns. Investors actually typically hold quite well-diversified portfolios. And what they care about is the risk-adjusted return or the Sharpe ratio. So, excess returns divided by volatility of their portfolio. And you can show that there's a simple way to measure the contribution of a strategy to the Sharpe ratio of that overall portfolio that investors hold. And that's obviously going to be different from the standalone return that the strategy delivers, right? So the contribution to portfolio risk and return is actually what investors care about. And that's what we try to assess here. And so what the asset pricing literature shows is that there's a simple criterion for testing the contribution to risk-adjusted returns of the overall portfolio, and that's the alpha of a strategy in a multi-factor model. So that's like the abnormal return in a multi-factor model. So it's the level of return that I cannot explain from exposure to common risk factors. Okay, and so this is explained here. So basically, if you think about the Sharpe ratio that you can have if you invest in some commonly known factors without ESG, and you're going to look at, well, how can you create a higher Sharpe ratio by combining ESG strategies with these well-known factors? Well, you can only get this higher Sharpe ratio if the alpha is not zero, right? So if, for example, there's a positive alpha, then you could actually give positive weight to ESG, and that would allow you to increase the Sharpe ratio. So the key question really is, is there a positive alpha when you adjust for these different factors? So we're going to estimate this multi-factor alpha in a very standard way. So we're just going to run these regressions to measure the exposure of ESG strategies to the different risk factors. And then we're going to estimate the level that cannot be explained by these factors, which is the alpha. So you have this time series regression noted down here. So we're going to be interested in estimates of this green term here, alpha of the strategy S. And what we're going to adjust for is the market factor, which is in blue here. And then additionally, we're also going to adjust for exposures to well-known equity style factors. So SMB is the size factor, HML is the value factor, MOM is the momentum factor, VOL is the low risk factor, PRO is the profitability factor, and INV is the investment factor. So low investment companies that invest conservatively, that's what this factor captures. And so we're going to look at different specifications of this so we can estimate this alpha when we drop these red terms. So we're only going to adjust for the market. That's not appropriate given that investors have access to these style factors, in quite a simple way. And also it's quite well documented that they carry a premium. So we also should include these style factors. So we also have this full specification, this full-blown model where we include both the blue term, this market exposure, but also the red terms, so these factor exposures. So what do we get when conducting these adjustments? Well, this is a table that shows you, so across these 6 different ways of using ESG ratings, so ESG, the subcomponents, then the momentum, and then the combination, we're just going to look at the estimates of outperformance that we get. And we're looking at this both in the US and then in developed markets, ex-US. So you're actually getting 12 different results here for 6 different strategies in 2 universes. Again, the annualized return, we've seen that before, is typically positive. The CAPM alpha also looks quite attractive. So, for example, for the environmental strategy, we get a CAPM alpha of 4%. But look at what happens when you adjust for these well-known equity style factors. So for the environmental strategy in the US, this alpha of 4% actually becomes, in the 7-factor model, an alpha of only 0.96%. So this is what we talk about when we say shrinkage. So this alpha clearly looks dramatically different when you actually adjust for these well-known factors. And actually, if you look across these 12 strategies and you look at the multi-factor alpha, none of these multi-factor alphas is actually significantly different from zero. Okay, so that shows that there is no value added in terms of performance over and beyond what these simple equity style factors explain. And this clearly is an important result. So just think about, go back to these ESG ratings with their forward-looking materiality. A lot of analysis goes into that. And then think about the equity style factors. So the equity style factors, they're really very mechanically constructed from accounting ratios, right? They don't require, an army of hundreds of analysts to, figure out what the book-to-market ratio is for a stock, or figuring out what the gross profitability is of a company. These are very simple, kind of very mechanical factors, and yet these ESG strategies do not add performance over and beyond these very simple factors. And the key link here is really with the quality-related factors. So this is shown here in this graph. Of course, we are adjusting performance for the market factor plus 6 style factors that I mentioned. But really the main action that we get is with the quality factors. So there's 2 quality-related factors: profitability and low investment, right? So it's well known that firms with high profitability tend to have higher returns in the long run, and also firms that invest conservatively actually have higher returns in the long run. And these ESG strategies just capture a lot of exposure to these quality factors. And what we computed here is simply the return contribution from these 2 factors, these quality factors, profitability and investment. So the return contribution is just, we're taking the exposure of the ESG strategies to these 2 factors, and then we are considering the returns of these factors over that period. So that gives us the return contribution. And what's plotted here are the annualized returns of the ESG strategies in blue, and then the return contribution of these 2 quality factors in red. So if you look at, for example, the aggregate ESG strategy in the US, so the return contribution from profitability and investment is basically, kind of the same level as the annualized return itself. It's actually slightly higher than the annualized return of the strategy. So in that sense, you could say that, in this case, these quality factors actually fully account for the ESG returns. And again, if we do that across these 12 portfolios, so if we look at the 6 different strategies in 2 different markets, we're actually getting, on average, that 75% of ESG returns are explained by these 2 factors. You have that in the rightmost bars here, so that's the average across the 12. You can see that there's about a 1% annualized return, and that about something like 70 basis points is actually explained simply by these two factors. And so that just shows us that clearly adjusting for these factors has a huge impact in the picture that you get on performance. So this clearly shows that for the strategies we look at and over the time period we look at, we actually do not get any performance benefits from using these ESG ratings. So we cannot say that performance is different from zero. So this is adjusting for factors. Now, we also show in the paper that there's quite substantial sector biases in these strategies. So a huge sector bias in the US is to technology stocks, for example. And what we did further is we just neutralized the strategies to avoid these sector biases. And that likely leads to quite dramatic shrinkage of the performance. So you have an overview here. So again, this is for the 6 different strategies. On top, you have the US. At the bottom, you have the developed ex-US. And if you just look at the aggregate ESG rating strategy, you can see this CAPM alpha, which is quite sizable again, something between 2 to 3% in blue. And now if you just select stocks and weight them so as to avoid any sector bias, you're actually getting close to 0% CAPM alpha. If then additionally you adjust for these 7 factors that we talked about, you're actually getting, again, a value that is not, distinguishable from 0, but is actually slightly negative. And then a final step that we, think is really important as well is that we're also accounting for the estimation uncertainty, right? So if you have a positive value of alpha, that doesn't mean that you can confidently conclude that truly you should expect a positive value. It could just be that given a small sample that you're looking at, the confidence bounds are so wide that alpha might still well be 0. So what you really want to look at is the lower bound of that confidence interval, right? That's kind of a conservative view that you can say, well, this is actually the value that even with let's say with high confidence, I would actually be I would have at least that outperformance. So these lower bounds, they actually clearly negative. And so definitely you cannot conclude that there's a positive performance from this. Now, going back to this graph initially, where you saw these upward sloping lines, we plotted a similar graph, but now we don't plot standalone returns or simple returns. Now we actually plot returns after adjusting for the sector and factor effects, right? So this is just basically outperformance over a benchmark. What's the benchmark? The benchmark is simply a portfolio that reflects the sector biases and factor biases of a given strategy. So these returns just look flat, right? And so the important point is that these are actually the lines that investors do care about, right? Because this tells you something about the value added to a broadly diversified portfolio. And so it's quite surprising that it's so popular and so widespread to show these upward sloping curves of simple returns, which frankly, are not relevant to investors, right? On the other hand, if you look at what's relevant to investors, this measure of alpha that these factors generate, you see that actually quite rarely, and we think that's quite surprising. This time series plot also gives you a view of what happens over time, and clearly it's kind of difficult to figure out whether there's any specific periods where performance looks particularly great. It's pretty consistently flat over time. So again, what's interesting here, I think, is really that you may have comments and criticism on the performance adjustments that we did. So we'd be quite happy to discuss the methodology. However, adjusting for equity style factors that are kind of very common, and adjusting for very common used sectors, really seems to be a very basic thing that anyone should do before, going out and saying, hey, I found some outperformance. And so we think it's, really surprising that, the papers on ESG performance have not necessarily looked at these kind of adjustments. Downside risk is another important issue. So think about, what we did is we computed this alpha in multi-factor models, so that's fine, that's standard methodology, but ESG strategies may have some benefits that, kind of don't show up in this analysis. And in particular, the benefit that people think about quite often is, maybe these strategies reduce downside risk. And so downside risk is about something asymmetric, right? It's not about just simple, say, for example, simple constant exposure to the market factor, as we have in our factor model. But you could think that, for example, a strategy actually avoids sensitivity to the market when the market is in really bad times. And on the other hand, when the market is doing well, the strategy may capture some of this exposure. And so there's a kind of asymmetric risk that could be important. And it has been argued, actually, that ESG strategies do offer such benefits. So it's important to consider that. So there's several papers, and they typically look at specific periods. So it's been shown, for example, that during the financial crisis and also during this market downturn at the beginning of 2020, that ESG leaders tended to perform better, and so maybe that's because they offer some downside risk reduction that you could identify. And so we actually want to account for that and want to see whether that changes our results. And so how do we actually account for downside risk? Well, we just augment our model with a downside risk factor. So we're going to conduct exactly the same analysis. There's just going to be one more factor, and that is a downside risk factor. So that's shown here. Basically, we have the initial model, and then we're just adding another term, which here we denote as D, so this kind of term is new. And what we would expect is basically that these ESG strategies should actually have, in a way, negative exposure to this downside risk factor. They should have less downside risk, and that could then change our estimate of alpha. And so that could actually turn positive after we adjust for downside risk. Well, the findings we have basically show that adding this downside risk factor doesn't really change anything. And that's basically a simple reason for that. So, maybe just to explain briefly what this downside risk factor is. So we draw on a paper by Ang, Chen, and Singh from 2006. So the downside risk factor is just a portfolio that holds, stocks that have a, strong kind of strongly positive downside beta. So they have kind of worsening market beta in bad times, and it goes short the stocks with the opposite feature. Okay, so this gives us an exposure to downside risk. The exposures that we get, once you adjust for all these different factors, are clearly not negative, right? So if you look at the downside beta in the full-blown model, this downside risk exposure is actually only negative in one case, which is the social rating strategy in the US. Okay, across all of the others, it's mostly insignificant. For 3 of the strategies, that actually a positive downside beta. The picture is different if you don't adjust for these other style factors. Then you actually do get some protection. But again, once you account for these factors, this disappears. So there's no special downside protection from ESG ratings. There is maybe some downside risk protection that comes as a byproduct of being exposed to quality. That's quite a plausible that's quite a plausible explanation for the differences that we see here. So since there are no substantial exposures to the downside risk factor, it would be very surprising if accounting for these exposures actually changed our conclusions, and we can actually show that it doesn't. So again, you have the shrinkage process here, where now we're looking at the CAPM alpha. We're going to additionally account for the downside risk, and you see very small differences in alpha when you account for downside risk. And again, then if you throw in the additional factors, you again get this result, even in the presence of the downside risk factor. Adding these different factors basically leads to this very pronounced shrinkage of the alpha. And so, accounting for downside risk doesn't change the picture. Now, that doesn't mean that, ESG investing could not be interesting to address specific kinds of sources of risk. Okay, so you could think about ESG analysis to help you to come up with for example, hedging climate risk or other types of risk that you may be looking out for. But what we just find here is that at least these types of ESG ratings do not seem to lead to any downside risk reduction in the way that it's typically defined in the literature, in this kind of general downside risk of increased sensitivity to the market in bad times. Okay, so let's say if an investor wants to exploit ESG strategies as a way to hedge risk, that could be a good idea. That would require further analysis, but this is not something that we look at in more detail here. ESG attention, clearly has been rising quite strongly over the past decade or two, and you do hear claims that that should have an effect on performance, and you don't only hear vague claims, but you actually have kind of rigorous models that make predictions about what happens when attention of investors changes. And so in particular, there's a theoretical model in a paper by Pastor, Stambau, and Taylor that makes a very important distinction between short-term ESG returns and long-term expected returns. And so what the paper shows, I kind of try to summarize this in a simple graph, and hopefully that does justice to the to the more rigorous model, but I think it carries the key idea. So imagine that there's like a point when just attention shifts, upward, and attention means that investors suddenly just care a lot more about aligning their portfolio with ESG values than they did before, right? This is what we call an attention shift. It could also be called a taste shift. Now, what basically this model tells you is that, okay, before this attention shift occurred, there is some long-term average return that investors expect from ESG leaders, okay, from stocks that also fulfill ESG criteria. Now, what's going to happen is there's going to be a period when attention shifts upward. And during that period, the model predicts that stocks will have a tailwind. So their performance is going to be boosted by this rise in attention, by this increasing demand to stocks that have high ESG ratings. So that will create a tailwind. And then the next question is, well, what happens after these attention shifts are over and then attention stays constant, right? So what the model says is that, well, there will actually be kind of a reversion. In a way, two types of reversion. So the first effect is that you're losing the tailwind. So now you're going back to this long-term average return as it was initially. But in addition, since valuations have gone up, there's going to be a drag on the long-term average. So that long-term average has actually decreased due to the attention shifts. Why is this important? Well, simply because this actually tells investors that they need to be very careful when they analyze, a sample with ESG returns. So if that sample is heavily affected by upward attention shifts, you know that the sample, there's actually a tailwind in the sample. So in other words, your returns may be, kind of inflated. So they may actually look much higher than the initial long-term average that investors could actually expect from ESG strategies if there hadn't been these attention shifts. And so that already tells you that, you could kind of come up with wrong conclusions over this long-term average because you're having this short-term boost in the sample. But in a way, the problem for investors is even worse because it's not just that they're going to lose the tailwind potentially going forward, but actually the long-term average return will have gone down after this has occurred. And so it's actually really important to try to disentangle these short-term effects from the more long-term effects. And so a pragmatic conclusion from this is, well, if you're an investor and you're a little bit conservative investor, so you want to make sure that your conclusions about returns potential are reasonable, well, then you should really be worried about relying too much on performance that happened during periods when attention shifted upwards, because you pick up this tailwind and that may not be there in the future, and plus your long-term average returns may actually have gone down. So you should be very prudent about making conclusions from these samples. And so how did that play out? What was actually the rise in attention to ESG? Well, here you see fund flows into sustainable funds. This is for the US. And you see a dramatic rise in flows. So these are net flows. And so clearly there were very strong inflows. And especially since about 2013, 2015. There were actually no period with strongly negative flows. So that's also important to note. So if you look at this overall period, you know that this period is actually driven by positive flows, or at least coincides with positive flows. You also know that especially the second half, and maybe especially the last quarter of the sample, was actually characterized by very positive fund flows. And so it's interesting to see whether there's any relation between these fund flows and performance. And so we just conducted quite a simple analysis. So our question was, okay, so does performance look different in the low attention periods and the high attention? Again, just note that when we say low attention periods, given the sample, low attention was still, basically rising attention. Okay, so we're just going to divide the sample here across the highest and the lowest attention periods. And you see a pretty pronounced difference that you get here in performance. So if you look at the CAPM alpha, for example, for this aggregate ESG strategy, and again, if you look at the US, that was 5% alpha in the high attention period, significantly positive, and it was 1.3% roughly in the low attention period, and that's not significantly different from zero. So you're getting a hugely larger CAPM alpha in these high attention periods. Okay, and so if you're a conservative investor, it could be reasonable to just look at the result during the low attention periods, right? If you're not convinced that attention will rise forever, and especially not in an unexpected fashion that no one has yet anticipated that, maybe looking at what happened during the low attention periods is a good idea. And again, just note that low attention here still is kind of pretty significant positive attention. So these results also suggest that it's important to account for these attention states. And again, if you look across the different strategies, actually in these low attention states, none of the strategies had significant alpha. Okay, and that's true even if you don't adjust for these additional factors. Okay, so again, it's a good idea to adjust for attention. Now, this also brings me back to this time series plot, right? So we've seen that, if you look at the performance, we've seen that really picked up about 2013, 2015. And also attention, really started to grow in 2013, 2015. So perhaps, what this implies is that any study that starts in like 2013, 2014 will actually be based, on these periods here. And so will really correspond to a period when, investors clearly, generated very strong flows into sustainable funds. And so that's something that should probably make you a bit prudent in terms of interpreting the results over this kind of time period from 2013-14. And, since we have this ESG ratings data since 2008 available to create strategies, we think that, we should use the full time period, including the one when attention shifts were a little bit lower. So again, going back to this picture of how do the alphas actually behave. So again, the blue line is kind of the naive analysis, just a CAPM alpha, especially if you focus on the high attention states. And, again, by picking the time period in a certain way, you could actually achieve that you mostly focus on these states. Well, you get a CAPM alpha of like 5%. That is divided by something like 4 if you go to the low attention states. And then if, again, additionally adjust for the factors and for the estimation risk, there's clearly no way that you could conclude that there's positive alpha in these strategies. So let me go to the conclusions. So we think that our conclusions are quite clear-cut, that, basically we conclude on 0 alpha for ESG strategies. There's clearly, from this analysis, no way for us to conclude that, alpha, there's kind of evidence that alpha is positive, okay? Now, this is an empirical analysis, so we use, again, certain type of ESG ratings. It's over a certain period. So, we need to be aware of that. But what we do, nevertheless, quite a kind of different analyses to make sure that our conclusions are robust. So first of all, we conduct a bunch of robustness checks. So we measured alpha with this 7-factor model. Well, you could say maybe instead you want to use like this Farmer French 5-factor model or some other kind of multi-factor model. So we've done this. Using different types of multi-factor models doesn't actually change the results. Also, when we look at downside risk, we had a very particular, very precise definition of downside risk. You could try to define this differently. So we also conducted additional analysis looking at different measures of downside risk that, again, are quite standard. So you have these approach, for example, where you make the market beta depend on economic conditions, macroeconomic conditions, and the results are basically the same. Also, we measured attention shifts using these fund flows. We think and in the literature, that's recommended as a good proxy for investor intention. But we also looked at different measures. So internet search volume, for example, that is for terms related to ESG investing. And even if you look at just the data on these attention shift time series, actually you get exactly the same pattern, this kind of very strong upward trend starting in around 2013-14. You get this similar trend when you look at, for example, data from Google Trends. And we conducted these conditioning on the Google Trends data, and that leads to, again, very similar results. I think even, let's say, more negative results for ESG alpha. So there's actually, for us, reasons to think that the results are quite robust. They clearly don't depend on a, certain specification. We would also argue that the alphas that we document here, they are, very small and not significant, but we would actually argue that they're probably still overstated, simply because, we actually have these 6 different ways of using the ratings. We're looking at that in 2 different universes. We also actually have a sector-neutral version where we adjust for the sector biases and the standard version. So that gives us a total of 24 strategies. And when we adjust for all of the factors, there's actually none of the 24 that has any positive and significant alpha. But in a way, the way that we test for statistical significance, it's actually not even stringent enough, okay? Because we don't adjust for the fact that we're running these 24 different tests, testing these 24 different strategies. So as is well known, if you just, test a large enough number of strategies, the standard statistical thresholds will just at some point, probably tell you that, one of these results is significant. But that's only because, that could be true even if there's no clearly kind of true effect that is there. And so in principle, we should, set a higher hurdle and actually adjust these alpha estimates and their significance levels for this multiple testing. We don't do that. Okay, so if anything, if we did these multiple testing adjustments, then things would even be less significantly different from 0, but like they're already not significant. So again, this just means that if we, add this more proper layer of adjusting for multiple testing, this would only reinforce our conclusion that there's really nothing that leads us to conclude that alpha is positive. Of course, it's just empirical analysis. So we're just looking at returns data. So, it could be that you think, well, these results are just not economically plausible, so you're still going to question them. Well, we would argue that the 0 alpha and absence of positive alpha isn't very surprising, because if you look at the economics, what are actually good reasons to think that there should be positive alpha? Well, first of all, if financial markets are somewhat competitive, this ESG information, which is, very widely available, could already be priced in, and there's some evidence that that's the case. And actually, even if this ESG information is like really useful to identify companies that have better, profit potential, etc. Again, like if markets know for this and know about this, right? If investors have learned this relation, then that should also be killing any alpha. And there's actually some evidence that, for example, some of the governance criteria that had led to outperformance in up to about 2000 have not actually done that afterwards because investors have learned about this. So our sample is 2008 onwards. So probably investors already had some information about the link between ESG performance and corporate performance. And finally, investors face trade-offs. So lots of investors have very good reasons to like investing in ESG leaders, even if they don't necessarily deliver alpha. And so if there's some trade-offs, you wouldn't really expect that buying the stocks that give you lots of non-financial benefits would somehow magically also at the same time give you alpha. So we don't find these results actually very surprising. In a way, what we find very surprising is that you have all these papers that claim that there's ESG alpha, even though that doesn't really hold, even if you conduct kind of very basic adjustments. And we think that looking at adjustments for factors, but also looking at just very basic things like accounting for the estimation risk, and hey, maybe let's look at a statistical test to see if things are significant. That's probably something that anyone should be doing. So what are the implications for investors? I already mentioned that. So do we conclude like with a negative view on ESG investing? Well, no, we don't have any negative comments on ESG investing. Investors may actually have lots of good reasons to use ESG investment strategies. What we do question is that, these papers that basically conclude very strongly that, ESG leads to alpha. The evidence we produced, clearly shows that, you just can't conclude on positive alpha. There's really no way from these results that you can conclude on positive alpha. And so what this also means, and what we would suggest, is that if there's something interesting about ESG strategies and kind of these types of ESG strategies, well, maybe we should look at some other questions. And we should think about, well, can you actually have a social impact using such kind of strategies? What do you maybe need to do to make sure that you really have a social impact? Can you use these strategies to align your investments with investors' norms? And what is it really important to align investments with norms? Additionally, you could also ask about hedging out specific risk factors. And so in order to really make sure that ESG strategies add value on these dimensions, it's really important to ask these questions. And I think just claiming without much kind of empirical proof that these strategies generate alpha, in a way, it probably also prevents us from asking the really important questions, which is what do we really need to do, and what is really the specific aspects of these ESG strategies that we need to take into account. Thank you very much for your attention.